In this analysis, we're taking a deep dive into OmniVision Group. The goal here is to look past the day-to-day market chatter and focus squarely on the numbers, because the data points to a fundamental transformation happening right now within the business.
So, here's how we'll break it down. We'll start with the big picture, the structural transformation. Then we'll look at the proof in the profits, pinpoint the new growth engine, assess the company's valuation, and wrap up with a clear-eyed look at the risks involved.
All right, let's get right to it. The core of our analysis centers on a major strategic pivot. So what's the big story here? It's all about a major pivot. OmniVision is strategically shifting its focus away from the up and down cycles of consumer electronics, think mobile phones, and doubling down on the automotive technology space. Now, why does this matter? Because the automotive sector offers higher growth and, crucially, much healthier margins. The endgame here is a fundamental upgrade to the company's bottom line and the overall quality of its business. All right, that's the thesis. But a theory is only as good as the evidence that supports it. So let's turn to the financials. And right away, the data from the first half of 2025 tells a really interesting story. Look at this scissor gap here. You've got revenue growing at a solid 15.4%. But look at net profit. It's surging, up 48.3%. Now, when you see a gap like that, with profits growing so much faster than sales, it's a huge signal. It tells you this isn't just about selling more stuff. It's about a structural improvement in how much money they make on what they sell. So that begs the question, doesn't it? Where is all this extra profitability actually coming from? And the answer becomes crystal clear when you break down the business. You've got two main parts. First, there's semiconductor design. This is the core of the business, making up over 70% of revenue. And look at that gross margin, 35.5%. Now compare that to the electronics distribution side, a tiny 3.8% margin. So it's no mystery, right? The company's profitability is overwhelmingly driven by that high-margin design work. And we can see this trend play out in the return on equity, or ROE. After hitting a low point back in 2022 and 2023 during an industry downturn, you see this massive rebound in 2024. Now, what's really important here is why it rebounded. It wasn't because the company took on more debt or just sold things faster. No, the engine behind this surge was a sharp recovery in the net profit margin. And at finance, that's what points to a genuine, high-quality improvement in earnings.
So, with that financial picture in mind, let's drill down into the new growth engine itself.
You can really think of this as a tale of two different business models operating under one roof. On one side, you have automotive electronics. Think long design cycles, high margins, and once you're designed into a car model, you get these stable, almost annuity-like revenue streams for years. Plus, it's got a huge tailwind from government policies pushing for things like advanced driver assistance systems. Then, on the other side, you've got mobile communications. Here, it's a totally different world, super short product cycles and fierce competition from giants like Sony and Samsung. So the strategy here has shifted from just chasing volume to focusing on high-value, profitable niches.
And this isn't just a plan on a PowerPoint slide. We're seeing the shift happen in real time. Just look at the revenue mix for image sensors. The slice of the pie from automotive has grown from 31% in all of 2024 to 37% in just the first half of 2025. That's a significant move in a very short period, showing real traction.
And of course, a new engine needs fuel. The company's backing this strategy with serious investment. In the first half of 2025, R&D spending was a hefty 15% of the design business's revenue. And they're not just spending randomly. That money is laser-focused on those future high-margin areas, especially the ADAS sensors that are becoming standard in new cars.
Okay, so we've established the transformation and seen the investment behind it. The next logical question is, how is the market pricing all of this in? Let's look at the valuation picture.
This table gives us a snapshot of where OmniVision stands next to its peers as of late September 2025. Its P/E ratio, which is basically the price you pay for $1 of its earnings, is sitting around 45. Now, how you interpret that number really depends on who you compare it to. You can see it's quite different from domestic competitors like Gigadevice or SMIC, and also from international players like ON Semiconductor. And importantly, you have to layer on top of that their expected earnings growth for the year.
So seeing those numbers, you have to ask, what's the argument for OmniVision trading at this level? What could possibly justify it?
Well, the case for what you might call a quality premium really boils down to four key points. First, its earnings growth is just projected to be stronger than many of its key competitors. Second, as we've seen, the business is shifting toward higher quality, more predictable revenue from the automotive sector.
Third, it's perfectly positioned to ride the massive long-term wave of ADS technology. And finally, there's the potential for the market to re-rate the company, that is, assign it a higher valuation multiple as investors start to fully appreciate this new, more stable business model.
But of course, no analysis is complete without looking at the other side of the coin. So let's be rigorous and examine the key risks and counterarguments. The bear case, or the argument against the company, really hinges on a few things. 1. You could argue the current valuation already has a lot of good news priced in. 2. What if the rapid growth in ADAS starts to slow down as the market gets saturated? 3. You've got these incredibly powerful automotive giants as customers who could always put pressure on margins. And 4th, the legacy mobile phone business, which is pretty saturated, could act as an anchor, dragging down overall performance.
And on top of those business-specific risks, there are some big external threats to consider. Geopolitical risks are very real. Things like U.S. export controls could suddenly cut off access to key technologies. The competition is absolutely brutal, with Sony as the 800-pound gorilla in the market, and folks like ON Semiconductor fighting hard in the automotive space. And finally, let's not forget the supply chain. Being a fabless company means they are completely dependent on foundries like TSMC to actually make their chips, which is a risk in itself. Now, there's one more recent event we need to factor into our analysis. A major shareholder recently announced they plan to sell a portion of their shares. Now, whenever you hear about an insider selling, it raises eyebrows. But the official reason given here is pretty specific. The sale is to repay loans and to reduce the amount of their stock that's pledged as collateral.
So, let's break that down. From an analytical perspective, the motivation appears to be more about personal financial housekeeping than a negative view on the company's future. The method they're using, block trades, is typically designed to cause minimal disruption to the stock price. And the scale of the sale, less than 2% of the total shares, is relatively small. So when you put it all together, the evidence suggests this is likely not a signal about the company's long-term direction. So, to bring it all together, what are the key takeaways? First, there's a clear, data-backed structural pivot happening towards the high-margin automotive sector, and it's already showing up in the results. Second, the profit growth we're seeing is being driven by this improvement in business quality, not just a simple cyclical bounce back. Third, the company's valuation seems to reflect these high-growth expectations. But, and this is a big but, all of this has to be weighed against some very real risks, from intense competition to geopolitics and potential market slowdowns.
And all of this leaves us with a final, crucial question for the future. We all know the automotive industry is becoming the next big tech battleground. Cars are essentially becoming computers on wheels. The question is, in that new landscape, can a component supplier, even a very good one, truly capture and hold on to long-term value? Or will they always be at the mercy of the giant car manufacturers who will inevitably squeeze their margins? That, I think, is the fundamental question that will determine the long-term story here.